All right, so today I wanted to make a video about a stock that another one that I've never talked about before, but I really like it, and I think it's probably about fair value where it's at right now. This is of all the stocks that I do not own that I want to own. This one's probably in my top 5. So I'm surprised I've never talked about it, but again, now's the time. So this is ITT. Again, they are in the machinery sector or industrial sector. They are building and providing parts for stuff that we need to run society, right? If you look at brake pads, shims, shock absorbers, transportation components, sealing technologies for cars, trucks, light and heavy duty commercial vehicles and military vehicles, bus, rail. Again, so they're fairly well diversified, and this is one of those industries that is not going away. This is a must-have industry. We cannot go without these kind of things, which is one of the main reasons that I really like this company. $10.4 billion company, so they're mid-cap, large cap, depending on how you want to define it, either on the smaller end of the large cap or higher end of the mid-cap. I would probably consider it a mid-cap. I don't think I would do it, but again, I don't know what the exact definitions are. Free cash flow yield and earnings yield just over 4%. I wish those were a little bit higher, but still not concerning, really. Dividend yield almost exactly 1%. I'll get into that later. Let's just briefly check out the insights, and I'll get into it more. Profitability is decent. It's not great, but it is decent. And again, these kind of companies, they're not really going to have a crazy high profitability. They're not like a software company or something like that. Management does a very good job. Return on equity, return on invested capital, both strong. Growth, they are growing fairly well. Financial health, current ratio 1.5. They're buying back shares. I'm not concerned there. Analysts, again, they're projected to grow earnings 23% next year, which is extremely good. The dividend is good. Valuation, they are below their historical PE, but they are a little above their historical price to free cash flow. So I'll get into that a little bit more later as well. Let's head into the financials and dig a little bit deeper here. If you look at revenue, again, consistent. Actually, it looks like they must have split or spun off or something back in 2008 or 2009. But ever since then, they have grown that. Again, they're not growing crazy fast, but they are growing. And if you look at earnings, again, a similar story here, a little bit all over the map. But if you go back a decade, they are growing. Also, shares outstanding, very important here. This has been trending down for the last 10 years. If you go back to the year ending 2014, 93 million shares outstanding. The year ending 2023, 82.7. So that's roughly 1% per year, give or take. So that's also good to see. If we look at the balance sheet, $1.4 billion in liabilities for a $10 billion company. That's not concerning at all. So that's good. If we look at the metrics here, profitability metrics have consistently gotten better over time. They're not crazy good by any means. Free cash flow did go negative in 2021, which is a little concerning, but they're back up to 13%. That's a solid number. I'm not concerned there. If we look at return on invested capital, 20%, return on equity, 16%. Those are both solid numbers. And then the last thing here, free cash flow per share, also at an all-time high. Or not all-time high, but decade high from this past year. Same goes for operating cash flow, revenue, all that kind of stuff. And if you look at revenue per share, that's actually been a pretty consistent trend higher. Again, not crazy good growth, but they are still growing. If we look at the dividend, they've grown it about 11% per year going back a decade. The payout ratio is 24%. So that's exactly what I like to see. If you look at the company, though, it's actually slightly underperformed the S&P. That's somewhat concerning, obviously, but you also have to keep in mind that in a higher rates environment, I think that a lot of the higher flying companies that relied on, at least to some degree, lower interest rates to get by, I think that that's going to hurt some of those companies. So I'm still I'm still confident in ITT. If we look at insiders, this is one thing that I've never actually looked at here. Insiders actually look like they're overwhelmingly buying, which is good to see. If we look at analysts, again, analysts are also bullish. There's not that many that cover it, but I mean the average price rating is 19% above where it's at right now. Even the lowest one is basically right where it's at right now. So let's get into valuations here just to see what is fair value as compared to where it's at right now, where should you buy it, et cetera, et cetera. So if you look at, I mean, PE probably is, at least of these metrics, probably the most consistent one to judge it based on. If we look at the average PE going back, let's say, a decade, is a little over 26, and it's currently a little below 25. So based on those numbers, it's probably, if anything, it's undervalued. If you look at its free cash flow, average is 25.8, currently 25.6. So I would say it's probably about fair value where it's at right now. Given the growth, I mean 12% growth per year as far as PE goes, to pay a 25 PE, I mean average in the S&P I believe is in that 10 to 12 mark. So I think that ideally you would pay below 25. I would say that 20 to 22 PE probably would be where I would look to pick it up. So based on those metrics, if we assume they're going to grow 10% per year, they're going to buy back 1% of their shares, they're going to go the dividend 10%, and you're going to pay a 20 PE. Fair value is 4.6% below where it's at right now, although the price will have changed a little bit between now and when this video comes out. So you're looking at about 121. If you want to give it a nice whole round number, 120. It's currently in the mid to high 120s. So if it comes down about 5%, that's where I would look to pick it up. If it went, let's say, below 115 or 110, that's when I think you'd be starting to get a really good deal on it. So that is ITT. Again, I really like this company because it is an industry that we really, really desperately need. This is an industry where demand is only going to go up, but you also have to keep in mind that just because demand is expected to go up in a particular industry doesn't necessarily mean that any particular company in said industry is going to do good. You have to make sure that they're a good company, they're profitable, they're managed well, they don't have excess debt, etc., etc. And I think this company is a pretty good example of that. So anyway, that is what I wanted to bring up today. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.